reading from the article that is coming. That's what at least one financial expert is saying. Charles Brown of CB3 Financial says,
one of the brilliant moves that Kmart has done is to partnership with Facebook in these e-gift certificates, so you can actually...
Of government mismanagement. Charles Brown is the president of CB3 Financial Group. He joins us this morning from Chicago.
Significantly dropping. Basically, this is the year of the consumer.
Believe that they're capable of managing anything?
Well, it's sort of like handing the keys to the chicken coop to two wolves.
Good evening, everyone, from Chicago. It's Thursday, July 9th. I'm your host, Charles Brown, Portfolio Manager with CB3 Financial Group. We are so glad you've joined us tonight. From COVID to clarity, this is CB3 Live. All right, tonight's top three, it's a little different. Coronavirus closes down Australia in a second wave. The second largest city is shut down. I'll tell you more in a few moments. ISM and other data shocks, and I have it in quotes because it's a good shock. It's good news. And instead of the bull case, bear case tonight, we're actually going to look at two of our portfolios' performance from the first half of the year. So let's get started, and we will take your questions tonight. First off, some people are still emailing us saying, hey, I want to make comments. I'm not able to do that. How do I do it? First thing is you need to use your Gmail account, log into YouTube, and then subscribe. And then, as you can see on the image here, click the little bell and you'll be notified of not just this publication, but others that we're doing. I started to tell you about that last week. I'm going to show you more this week. It's really important if you want to keep up. For those of you that have followed me on Twitter for years, I've got hundreds of followers. I'm actually going to eventually discontinue that feed and just focus on this new CB3 Live Twitter. So please follow me on Twitter, simply because the speed at which news is now moving between the second wave of COVID, we have an election that's less than 4 months away. I want to be able to get you the most recent salient news that's going to affect your financial future. So sign up if you can. Coronavirus, it's back. It's back, and the people in Australia are not happy about it. The BBC reports Australia's second largest city, Melbourne, behind Sydney, is in lockdown, meaning 5 million residents are barred from leaving their home for 6 weeks. Sounds like New York City, right? Except that they can go out for essential reasons. Well, we'll see how long that lasts, but still not a good sign. What's interesting to me is that it's actually cold down there now, and it's our southern cities that are having the issues here. Encouraging, though, is though even though we had 58,600 new cases yesterday, this data is from this morning, only 820 deaths. I always have to preface that by saying, of course, if you know someone in those 820, it's a really big, horrible deal to you. And I don't ever want to downplay that. But that's just a little over 1%. So the numbers are moving in favor of this being less of a pandemic. And I'll explain that in just a moment. So what does this mean? All right. We have a chart. I just scooted past it. This is from the CDC. You're thinking of the United States Center for Disease Control. This is the Euro CDC actually discussing what's going on in America and showing that our profile actually looks very encouraging. Even though the number of cases are skyrocketing, the morbidity rate, the death rate is not doing that. And you can see the flat line. Actually, if you look really carefully, you'll see it's going down in relation to the number of cases. That is a positive in the right direction. So deaths attributed to pneumonia, COVID-19 decreased 9% in week 25, which started back in February, 5.9% in week 26. So that's a good number. And the CDC is actually saying it's the 10th straight week of declining deaths. And what I alluded to on the last slide was they're saying that at this percentage change threshold, this pandemic could actually be downgraded to an epidemic if the cases increase, but the death rate remains the same or even drops, because a pandemic or epidemic is rated based on the number of fatalities. So that's a positive. Interesting is that in Europe, they did not see the spike. If you remember from last week and the week before, I was showing you this declining chart, and then there was a spike in both cases and deaths, not too badly on the deaths, but on the cases, yeah, and that's because of the southern states. They're not seeing that in Europe. And in fact, if you look at the testing and new deaths per million, the whole graph is going down. I put the red line on here because if you look at it logarithmically, they are decreasing across the globe. Now, I realize that's not the story that you're getting in the media, but this is the hard data. I actually had someone question my data this week, so if I seem a little extra feisty tonight, I'm trying to be very clear. Every slide that you see here is sourced. So if you watch this again, you can see the source. You can go check the source for yourself. I feel confident in the data that we bring to you. Now, here's a map of the U.S., of course, but careful at what you're seeing. This is not COVID-19. This is the effect of negative GDP on what the pandemic has done. So the darker states have had actually a less of an impact. So you want to be Florida or Texas or any of those Midwestern states. And the blue states are the ones that have had a greater impact on their GDP. Up in the Northeast, you'll see as much as a 6.1% drop. It's pretty enormous compared to the states. And you can look at Alaska, no impact. Hawaii, huge impact. And then you see Nevada standing out. Well, that's actually all pretty much one city, but still substantive if you are in one of those areas. Now, last week I talked about contact tracing and the new career possibilities that you can have if you want to be a contact tracer. Well, the issue is we can't find enough people to do this work because the contact tracing is not keeping up with America's reopening, which is one of the reasons why they're having to go back and shut down again. It's the reason they did it in Australia. It's the reason they're doing it in parts of this country, even though Disney is going ahead with opening up in Florida. But more interactions create more work for this contact tracing. And I think, frankly, this is the new job frontier, understanding how to trace infections and warn people to stay away from other people or to quarantine them. So U.S. applications for unemployment insurance. I've been showing these ghastly charts, and here's one that's flattening out. I liked this because it's not increasing. It's actually flattening out. You can see the last 2 to 3 weeks hardly budging. Is it still high? Absolutely. Look at the numbers before the bars started getting huge. So we're still clearly elevated, but we are flattening and moving in the right direction. Now, the Federal Reserve has 12 districts throughout the United States. St. Louis, similar in the Midwest, their president said, look, based on the data we're seeing, we think we can get into single digits for unemployment. Now, before this happened in February, we were enjoying a 3.4 to 3.5% unemployment rate. That skyrocketed to 14. Many thought it was going to be higher than that. Now, this particular Fed, who again is looking at his region and extrapolating from there, saying that we could get to 8, maybe even 7% unemployment. Now, we don't want to see 7% unemployment, but compared to 14, remember, since I started doing this in mid-March, we're just trying to get numbers that are moving the trajectory in the right direction. That's what we're hoping to see. Here's another chart that I really like. Layoffs and discharges have plummeted. They skyrocketed, okay, in March and April, and then look at the plummet. Once the initial layoffs and discharges started happening, they started to drop. And look at hiring. That crossed over last week. So we're actually seeing more hirings and less firings and discharges. I don't know if they're firings, but they're layoffs and discharges. That, again, is a very positive statistic. Optimism. Now, this is a chart I've never shown you. This is from Duke University and the Richmond and Atlanta Fed. Remember, each of the Federal Reserves talks about developments in their particular territory. They interviewed CFOs. Okay, so that's the chief financial officer of the companies, the big companies. and said, so are you optimistic about the economy or are you optimistic about your company? Well, almost all of them, and of course, as a CFO, you have intimate knowledge of your company. Almost all of them are saying, yeah, we think we're going to be fine. We're going to get through this. It's tough, but we're going to get through it. But their view on the economy was not as good. I think this is interesting because they have self-confidence in what they can observe, but not so much confidence because of what they hear, I think, in the media and from other people. So why have Americans moved? Well, for the most part, it's not because there are no jobs. It's not because they were laid off, even though that's part of the reason, under 10%. Mostly it's because they wanted to be in an area where there was less COVID-19 exposure. And for the most part in America, that means moving from urban to deep suburban, meaning at the edge of the periphery there, or rural. If you can work from home and you can move to a rural area, that's what we're seeing in this country right now, at least the tendency for that. Another tendency we're seeing is that even though there was a rise in people going back to restaurants, many of the younger generations, I like this, Gen Zers, millennials, mine's easy, baby boomer, are saying, you know what, we're just going to cook at home. We're just going to cook at home. We're kind of enjoying it. That's what we're going to do. And that's the direction things are moving. Now, you've heard probably also that people's spending has been cut back dramatically, and the rich people are recovering more quickly than the less wealthy. Well, again, this chart from Hugo St. Marie, which is kind of an odd service, but it's one I subscribe to. The Wall Street Journal carries their feed. The red line is showing the recovery of low-income spending, and the blue line, the recovery of high-income spending. Who's recovering quicker? The lower-income people, which means they're getting the tax support. They're getting the refund either from their tax from the previous year, from this year, I should say, 2019, right? They're using that to spend, or they're getting unemployment insurance, which they're able to use in place of a job. Now, once we get to September and some of these benefits start to run out, it could get a little bit trickier, and that's what I plan to cover, obviously, in the next couple months. If you look at a typical year, job postings in 2018 and 2019 tend to rise in the spring and then flatten out over the summer. Well, obviously, we plummeted in the winter and spring months, and look at this recovery here. Again, it's not where we want to be. We don't want to be at a minus 20% from a year ago. But this recovery is starting to look maybe not like a V, but at least like a U. And that's something that's very positive for those working. Now, you're not going to be able to see everything on this chart, but what you're looking for is just the blue numbers, okay? So going out to eat, going on vacation, going to a shopping mall, 35% of people are willing to go out to eat. That means 65 are not. Going to the movies, 20%. That means 80% are not. Going to the gym, 18%. Means 82 are not. Going to a concert, which I have a special affinity about, 15% are willing to go, but that means 85 are not. That means a lot of virtual concerts coming up, or as some of the country music stars are doing, go to the drive-in and we'll play it over Zoom in the drive-in. So we have a ways to go as far as people's comfort. And we're seeing that here, and that's because people started to go back to the restaurants and eat. You can see the just huge rise in Florida and Arizona that peaked out and now dropping back down again. We saw the beginnings of this 2 weeks ago. We saw it get worse last week. Now it's really heading down, except for New York. And I think that's because New York had it so bad for so long that residents there are saying, gosh, it can't get any worse than this. So different parts of the country are reacting differently. And that's what I'm trying to track to bring you this news and see how it's going to affect our investing. I said this last week, but I think it's worth saying again, that sometimes there are months where decades of transformation will happen. Sometimes there are just months where decades of transformation will happen. And I believe this is such a time. I think that you are seeing fundamental shifts in spending patterns, comfort patterns, healthy living patterns. And these changes are affecting many, many industries, and it's really a tale of two markets, which I'll get to in the investing section. Okay, so now it's time for your input. Is southern U.S. increased case reporting of COVID-19 concerning to you? And I'm really zooming in on, no pun intended, on the southern part of the U.S. tonight, because it's Florida and Texas and Louisiana and Arizona that are showing the problems. And part of it's because they're in the South, and for whatever reason, this virus just seems to go nuts in hot, humid weather, although you could argue Arizona's dry. But the other reason is because the younger people in those areas are just refusing to wear masks and refusing to stop congregating. So what do you think? What do you think? I got my first answer here from Nellie. Let's see, we got a no, this had to happen, all will be okay. That's good. Martha, same thing. Hey, Martha, how are you? Welcome. Anybody else? Anybody else? We got 2 C's. We got 3 C's from Andre. Hey, Andre from New York. More testing, more results. There are people getting together. There are. Yeah, I hope they're wearing masks. I went on my rant last week about masks, so I'm not going to do it this week. Tommy, yes, but I expected it. Yep. Okay, got it. Anybody else? D, I'm waiting until more news. Yeah, well, go on vacation. Doc, it concerns me a great deal. I bet. IB. All right, Doc, thank you for that. Jay. Guys, keep sending those answers. Let's move forward. So, how many of you saw this on Monday? You remember last week I said I'm going to start a new series because there's so much happening over the weekends. I felt compelled to do a short, and I want to emphasize short piece called the Monday Market Mashup. I'm trying to have it to you by 5 p.m. Central Time. I think last week was 1 minute and 20 seconds. It might be a little bit longer once I get the flow of it there. Nothing fancy, but I just want to get you guys ready for what I'm seeing at the beginning of a week. And I just want you to know that's there. So that'll be in your inbox. You should see notice that I've published that, sometime on Monday. And let me know. Give me your feedback on what you think. Hey, Mark, thanks for your C on that. So, and here's the next thing, okay? So people have been asking me, you do these long 45-minute videos, but I've got kids or I've got a friend that just, want to hear some of the wisdom that you have, but they won't sit through 40, 45 minutes because they're not a client. Okay, so I heard you loud and clear. So what I have is I've got a series of 7 money lessons, and they're on our YouTube site, and we're going to show you how to get to that. But you can literally just hit the playlist and you can watch money lessons. So I'm going to actually show you one of these as I answer some more questions, and you'll be able to see what we've got in mind for money lessons. And please feel free to give me feedback on this as well. Okay? Thank you. Hi, I'm Charles Brown, a portfolio manager here in Chicagoland. I've been doing this for 30 years, and today this money lesson is about how corporate earnings affect stock market performance. People ask me what really moves the stock market. In CB3's 3-on-3 video series, we talk about social and political, fundamentals and news, and technical analysis as the 3 significant contributors to stock market movement. Today's lesson on corporate earnings belongs in the fundamentals category. The relationship between a company's earnings and its stock price can be complicated. There are many, many factors that determine a fairly valued stock, some of which you see on this graphic. High profits don't necessarily mean a high stock price, and big losses don't always lead to a low stock price. 2 of the major factors that influence stock price are current earnings per share, or EPS, and the promise of future earnings. Now, investors are willing to pay for future earnings unless, of course, those future earnings disappoint investors' expectations. Looking at this chart, you'll see stocks track roughly in line with a multiple of their earnings. That is until the year 2007, when, as you can see, price ran away from earnings to the upside. Do you see that ugly red line plummeting? What began as a market correction turned into a full-fledged bear market in 2008. Corporate earnings, among other factors, did not meet investors' expectations, and ugly things can happen when corporate earnings disappoint investors. Before most companies report their quarterly financial results, analysts predict the EPS for the quarter based on the company's guidance and other factors. If a company beats those projected earnings, its stock price usually goes up. But if a company fails to reach those projected earnings, its stock price most likely will decline. Let me take this graphic full screen so you can see the third quarter to date earnings scorecard. This scorecard is a sector-by-sector ranking of those stocks that beat and those that underperformed their earnings estimates. As of November 6, just a few days ago, 72% reported above, or that is better than forecasted earnings, but that still means that 28% took it on the chin. I hope you enjoyed this money lesson about how corporate earnings are a major driver behind stock market performance. Thanks for watching. Please give us a like if you found this money lesson useful. I'm Charles Brown, and we'll see you next time. All right, well, there we are. So that was done actually a couple years ago, but we're going to freshen up this series. We're planning on doing new topics, many suggestions I've gotten, probably half a dozen, but I'd like to know what you would like to know, because again, I understand the purpose of Thursday night is to give you just a total overhaul on what's happened during the week. The point of Monday now is to just prepare you as to what I'm seeing as the week begins, but this series, which we call an evergreen series, is going to be something that, as you can see, 3 years later or 2 years later, it still works. So either for you or your kids or even your grandkids, let me know. We're in the business to produce educational content as well as manage your portfolios. And I think we can all admit that this year is going to be one of the most volatile, one of the most trajectory changing in American history. So here we go with the U.S. economy. The NASDAQ up 17.6% on the year. The S&P negative, the Dow negative, the Russell just about in a bear market. I find that just astounding. There is a 34% difference between the NASDAQ and the Russell. Folks, this is a market of two markets. That's the reality. It's a tale of two markets. COVID-19 has created this dichotomy of risk. The market indices are not telling the full story. We have a simultaneous bull and bear market. This convergence of correlations, if you will, has created a market of really only two trades. You're either in sync with what's happening in COVID or you are not. And the market is pricing itself correctly due to central bank intervention. So if you look at the NASDAQ on the left-hand side, what are we seeing? The NASDAQ, 45% is in technology, 20% in communication services. That's going to be Facebook and other communication entities. Consumer discretionary, 17%, healthcare, 8%. These four groups total 90% of QQQ. That is enormous. Now let's contrast this with the S&P. 24%, 11, and 15. Four sectors representing 61 as opposed to 90%. So who's doing well right now? Mega cap stocks. Who do you think is going to be successful? Mega cap stocks in the sectors that are growing. And that is why QQQ is doing so well. That's why the NASDAQ is doing so well. Only one trend really seems to matter. It's not even the trend of the coronavirus. It's certainly not the trend in earnings growth, although we are seeing some pretty surprising earnings, which I'll get to in several slides from now. What really matters is what is the trend of the mega cap stocks. And these are the FANGs. You've heard that acronym. Facebook, Amazon, Apple, Netflix, Google, which is Alphabet. And then you have to put the M on the end for Microsoft. Somebody's going to come up with a new acronym, I'm sure. But that's where the money's flowing. That's where the market is investing. We're still seeing good data. I showed you consumer price index last week. I'm showing you ISM this week, non-manufacturing. So I showed you manufacturing. I've shown you the consumer data, 2 previous episodes. This is the non-manufacturing index. The prediction was 50.2. The actual was 57.1. That is what I call a jackknife. I like that phrase, especially if it goes in the direction I want it to. A huge jackknife from way down there, looking almost as bad as 2008, now back on the expansion side above 50. It's just great data. And if you look at the data that I gave you last week, I superimposed it on this chart. Non-manufacturing and manufacturing, I mean, folks, they just jackknife. You can see the gray sliver there. That indicates that we are technically in a recession, even though it hasn't been declared. You can't declare a recession until there have been 2 negative quarters. We already know the first quarter is negative 4.8%. The second quarter is going to be negative by more than that, but we won't officially get that data until sometime in September. But we all know where the trajectory is headed, and it's headed in the right direction. There was even an unexpected jump in job openings. Now, it's not a big jump. You see that little move up there on the black line in the latest week? But I'll take it. It's improvement. Okay, all the direness that you hear, that means there are job openings and some that have not been filled. I even searched to find good news on the airlines. Now, we have a daughter that works for American Airlines, and we are concerned for her and her job. But I'll tell you what, if you look at Spirit, JetBlue, Southwest, not as good, but certainly Spirit and JetBlue, I mean, there is some good news that they are back to where they were in February. Now, maybe it's their business model. Maybe it's because they don't have the legacy expenses of the huge airlines. But I'm looking at that as a very positive sign. Okay? All right, and I know there's questions in the clip here. Let me get to those in just a second, all right? So this is another interesting trend. You would think, well, when people can finally get out and start spending, they're going to spend at megabuck places. Well, that's not the data that I'm seeing from Seeking Alpha. In fact, TJ Maxx and Ross stores totally blew away Kohl's and Macy's and Nordstrom. I mean, really, that's been the case since March. I mean, people are expecting to maybe not go back to work any day now, if that could happen. And what they're doing is they're spending their money at lower price stores. That's why Walmart has done nothing but be strong during this period. So what are people deciding not to spend money on? Now, this chart is as interesting to me on what they're not going to spend money on as what they are. So tickets for movies, they're going to spend a whole lot less. Look at the black line versus the blue line. Same thing with sporting events. I mean, in sporting events, sorry for the editorial here, but gosh, with all the political stuff going on with sports, and then you add COVID on top to it, I don't know what it's going to be like this autumn in America. In football, pro and college, I really don't. Going to bars, eating at restaurants, but look at childcare services. One of our daughters is in the nanny business, and she reports her business in Boston and Chicago. She has 2 offices, really has never been stronger. And I think she's surprised at that because no one knew what to expect. And here's the one that I like. Those of you that were on last week, you saw my interview with Pastor Bill at Moody Church Chicago. Charity has gone up. I think people have been scared. They've been shaken, and for whatever reason, folks, if you can trust creditcards.com, I don't know why they wouldn't be a good source. People have decided to be generous and to give to charities. Now, who's hurting right now are state and local governments, because when people are out of work, they get unemployment benefits, those people that are out of work, but that doesn't translate necessarily into revenue at the state and local level. So I don't know if this means higher taxes down the road or fewer services. For those of us in the north with snow, we're probably going to be a lot more potholes, which doesn't excite me too much. But that's reality. Now, this recovery tracker, I've been showing this every week. I don't like this trajectory on the health side. I mean, we're seeing a little progress made in the financial sectors, in mobility, production, employment, just overall demand of services. Boy, the health recovery just not looking good. And it's not a surprise to us. It's not a surprise. So I'm going to give you this question, and while you're answering it, because we're on about a 25-second delay, I'm going to look through the list here. I think there's quite a few things to answer. So what is the significance of all these endless economic reports I give you? A, they're not trustworthy. I hope you don't check that, because they are. But if you do, you won't be banned, I assure you. And maybe you think I'm telling you the truth based on what I see, but you're just not sure the sources are telling you the truth. So, okay. Or B, they're the calm before the storm of the huge second wave of COVID-19. C, human nature is to be negative, and I believe the best is yet to come for our country. Or D, just not sure what to think about it. So while you come up with some questions, let me scroll back here, and I got to pick up some questions that have come to me in the chat. Yes, Nellie, Tommy is working me like crazy. And I tell you what, folks, that's the only reason that I'm still sitting here with my pulse still going, is because I'm working out 3 days a week with a trainer. If you're not doing it, and you're not getting out and exercising, you need to private message me and I'll get you guys connected, because it's the only reason I'm still sitting here with energy. But thanks for your good wishes on that, Nellie. Andre, yeah, more testing. I get you. Agree with Andre. Nellie says, okay, Greg, heck yes. Maybe bar hoppers will kill off all grandparents. Oh, no. I hope not. Oh, I hope not, Greg. But yeah, I mean, they congregate and they need to put their masks on and stay farther away. You can still have fun, but just don't breathe each other's breath and mucus and whatever else. That's exactly right. All right, keep answering questions. Andre, not going to restaurants in Upper New York. Okay, I got you. Thanks, Doc, for the feedback on that clip. Yeah, if you guys like that money lessons there, I'll do more of that. Wish I'd had that info as a young adult, Nellie. Hey, I wish I'd had that information too. They didn't teach that back at Fort Pierce Central, did that? I heard today that the NASDAQ will make a dive and then will go up. I think it will make a dive at some point and then it will go up. I absolutely agree. Now, if I could give you the exact dates on that, we would all be much richer, wouldn't we? So, yes, United announcing upcoming layoffs. We're seeing that with American. There is still a ton of need. I mean, I don't downplay that. There's going to be a retraining. There is going to be a retraining. Looking at the answers, I got human natures to be negative, and now I'm getting to the answers here. So C. All right, put it in God's hands, says Tom. D, not sure. Okay, Mark, we'll see. Hey, Fran, welcome. I think you're in North Dakota. Welcome from North Dakota. That gives us 4 time zones tonight. I like that picture. I hope that's near your place out there. And so, yeah, I think that's all of them. Mark Burns, tired from all the reports, too much negative opinion. Hey, Mark, I hear you, man, and that's why I'm here trying to give you good news. I really am. So, B, second wave is a huge thing happening regardless of the White House blather, okay? Yeah, the wave is going to happen no matter what. So I'm reading through this here. If you're a grandparent, stay away from your grandchildren. Okay, you'll have to tell Alice that because she's having a difficult time. I'm happy to tap on the window and wave and say I'll see you soon. But guys, I hope I answered most of your questions here. Let's keep going. I've said this in various ways over the last 10 to 12 weeks. This is episode 18, so we've been doing this a while. You got to stop believing that the economy is the same as the stock market. The economy is getting better, even though it's not great. It's recovering, but the market is actually doing quite well. There are many fallacies that continue to be perpetrated, and it's hurt many people because the guys on Bloomberg, that's right, Bloomberg with a G, quietly under their breath say, well, I'm still in cash. Okay, well, you're not believing the charts that you're seeing. And you've got to be able to free yourself from what holds you back, and your account will grow. I really believe that. And I'm going to discuss tonight. That's why I didn't do bull bear tonight and just pick a few stocks. I'm actually going to discuss 2 of our programs, mainly because I had somebody who was not too happy that sent me kind of a testy email saying, I'm watching your show and I don't really think you're trading your stuff. Are you really investing in what you're talking about? Well, you'll see. Okay? The stock market is confusing a lot of people right now. It seems simple. The news is bad. There's a pandemic for the first time in 100 years, although you remember earlier that if the European CDC downgrades that to an epidemic, I'm going to be putting out on a tweet immediately and probably go live in the middle of the week or the middle of the night to make that announcement. Because what that'll mean is that, sure, the number of cases are going up. I almost want them to go up because I think they're out there anyway. We're just not reporting them. But if the deaths stay the same or drop, we're going to see this COVID-19 experience downgraded to an epidemic. I am not making that prediction yet, but I'm seeing data that suggests that it's a possibility. And as recently as last Thursday night, I didn't think so. Less than 4 months ago, the stock market was in a free fall. Torrent of bad news. We still have a torrent of bad news. The market has recovered because it's discounting the bad news. Why? Because the market looks ahead. You guys know this. I've taught this to you for 18 weeks now. 6, 9, 15, 18 months ahead. Okay? The market with the biggest players wagering real money is worth a whole lot more than a bunch of economists who have PhDs that are hanging out in Ivy League schools that might not even be investing, or they're putting their money in cash when the NASDAQ has made an almost 60% recovery from March 23rd. Who do you want to believe? Who do you want to believe? As you know, this little chart I show you almost every week, we see this when we're starting to report earnings. And as you know, we're here in early July, so we're reporting earnings from the second quarter. Okay? So 82% of the companies surveyed that have released earnings have beat them. Only 18 failed, and on the revenue side, 71%. These are both traditionally higher percentages than we see. I get it. They're lowballing it. They have lowered expectations. Some of them have even stopped issuing earnings forecasts. I get that too. This will mean a lot more in September when we see earnings coming out really for July and August. But for now, it's the data that we have to go on. Okay? Now, you would think that the brightest minds in the world, hedge fund operators that have been charging people huge exorbitant fees for years, would be doing well in this, and yet they are underperforming the S&P, and as you'll see, they are dramatically underperforming those of you that are in my CG program, and DG for that matter. If you go back through the years, high fees, incentive payments that you have to make to be with big hedge fund players, I mean, billions and billions and billions, probably a couple $100 billion have left hedge funds since I started doing this series on March 12th. And so what I want to go into tonight is to show you 2 of our 4 programs. And next week, I'll look back and show you the other 2 programs on how they've done this year to date. Part of this is I don't talk about performance that often. I can, but I want to give you education. But for those of you that are clients, you're going to see 2 programs that you're in. And if you're not a client, and if that person that sent me that email happens to be on the line, here is my actual account statement. Now, obviously, I can't put the whole 42 pages on here, but if anybody wants to see it, just contact me and I'll send it to you. I'm going to block out the account numbers, obviously, but I will not block out the amounts. I'm happy to show you what our family's committed. I've mentioned it many times. I'm not going to say it here. There's no need to. But we are up 21% as of yesterday's close. As of today's close, which I can't even put in here because I don't have time to put it in before the broadcast, it's another 125 basis points. Now you would say, well, that's a pretty good return. Well, the S&P is negative. The S&P is negative by 188. So if you add the 2 of them together, we're up 2,322 points. Now that puts us, frankly, folks, in the top 0.3% of money managers in America. Now, that said, if I had a 10-year track record with that, I would not be on this broadcast. I would have an entire floor to myself with my staff at Goldman Sachs in New York. Okay, so I don't have a 10-year track record with this. I do have several years. But the reality is you can beat the market. And there is a strategy for doing so. And you guys can ask me questions tonight. That's why I have focused in on this and we're not doing the other segments. We didn't have a guest tonight. I want you to have ample time with this. Let me show you one way that this works. Carefully look at the chart here. So if you want market performance, then just invest exactly like the S&P is invested. Well, I don't want market performance. I want better than market performance. 1, because it's my money. And 2, because those of you that are on the line here that are clients know that I'm investing the same way for myself that I do for you. Now, let me be clear. If you're not a client, that doesn't mean that we're all in one big account like Bernie Madoff. Everybody has separate accounts and everybody has separate weightings. So I might have 40%, which I don't, but I might have 40% of my total net worth in CG. And Sally Smith might have 22% because she has less risk tolerance. And we can talk about that in another episode. But the reality is that you need to pick the places where the market's working, and you need to not pick the places that the market's not working. Now, that's something that's overlooked by a lot of people. Look at the financials highlighted here. I began the quarter with 21%. I'm going to forget the rounding here. 21% in CG versus 12%, because I thought at the beginning of the year that financials were going to do quite well because I expected the 10-year yield to rise. I was wrong. I didn't stay there. Now I have 0%. If you go over to the ending weight, the ending weight is yesterday's close, and the S&P still has 9.5. But go down to technology. I started the year with 30%, which is already more than the S&P. I'm at 52.9. We're going to call it 53% in technology. Okay, that's a big difference. What's the number one performing sector? Technology. What's number two? Consumer discretionary. What's my number two weighting? Consumer discretionary. Okay, so we don't try to tell the market what to do. We see where the market's going and we hop on the train. Am I a coattailer? You bet I am. I don't have enough money under management to move the markets. In fact, very few people do these days, even Warren Buffett. Even Warren Buffett. Now, if we look at our second program, diversified growth, capital growth is riskier. So you see those kinds of numbers because the people in there are willing to take substantive risk because all the investments are in individual stocks. So obviously your risk has to be appropriate for your willing to have rate of return. Right now, CG is really, really doing well. But DG, which stands for diversified growth instead of capital growth, is also doing pretty well. So the point of this program is that it invests in exchange-traded funds that trade various sectors of the market. Remember, I showed you those in the previous graph, as well as other assets like gold and silver, natural gas, and we're invested in China. We actually have an investment right now in Germany, so stocks that trade on the Hamburg Exchange, the Berlin Exchange. And if you see the blue line here, we're up 4.68%, which doesn't sound nearly as good as CG, but the risk to this, because there are no individual stocks, is much less. Okay, we are beating the market in diversified growth by 6.56, again, because the S&P is down. We're up 4, it's down 1 and 8, so we're up 6.56. Most people would be very, very happy with that, and the risk on this program is actually what we call 10 beta points lower than the market. Okay, so I want to pause here just for a minute. Actually, I'm going to go to one more screen. I can't exactly display this the same way as the other one when you saw the various sectors. What I can do is put this on a graph and show you. Do you see the aberration way out there? That's technology. So there is a lot of technology in what we call sector ETFs as well as industry ETFs. Now, if you want to know more about any of this, I can dig down into it. But the point of this is everything that I tell you on this program relates to real life trading. There's nothing hypothetical. If I am a bull, it's because we own it. If I'm a bear, it's because we don't own it or we've just sold it. So this is not hypothetical. And again, if you're the one who sent me that email, and I hope you're online right now, these are audited statements from Interactive Brokers, one of the largest clearing firms in the world. Happy to make them available to you if you would like to see them. Let me go back now and see what questions I have. Mark, yeah, see, you're driving to Colorado. Yep, and we're thinking we're going to be driving anywhere too. Hard to believe they're in cash. Martha, the biggest names, you would be astounded, Martha, at the number of people that are in cash. It makes no sense. Okay, people need to get out. They do. And stated from somebody in Michigan where your governor does not really aid much in that. Thieves, yeah, well, you said it, not me, okay? All right. Any more questions on this, guys? This is a little bit shorter episode, just a tiny bit. I just want to say, guys, it just means a lot to me that you're here listening. Go out there to YouTube, though, because I want to give you this new content. I'm excited about it. I think it's going to be useful for you. Just go to YouTube, hit that little bell. You can see it right there. Okay. And the same thing with Twitter. I know a lot of you guys that are online and that are seeing this and that actually see the playback. You're on my other Twitter account. There's like hundreds of people on there for 10 years. But I'm dropping that because there's just so much junk, not junk mail, but junk tweets. So you can, when you get the email on Monday, just click the little bird and just sign up for my tweets. I tweet every single day, sometimes twice. if there's something really going on. And again, we've got an election. We've got COVID-19 round 2. We have anything else that could be a surprise. I mean, we haven't even heard from Kim Jong-un or really Putin. I mean, sort of. But I mean, imagine if some sort of international thing were to come up. This market is moving fast. And I want to be able to get you the information that you need to understand why I'm making the decisions that I'm making for your portfolio. And that's if you're a client. If you're not a client, please keep coming back here because I'm willing to give you this education. I'm willing to explain to you why I'm making the decisions that I'm making for my clients. You don't have to be a client. Candidly, any of my clients are smart enough to do this on their own. Most of them just don't want to. It's not rocket science. So if you just want to hang out here on this YouTube channel and learn from what we're doing here and learn from each other, I mean, we've had times when you guys are talking between yourselves. I love that. You know, that's great. You can do that, all right? And I'm glad to see you there doing that. So this is how you can reach us: email, phone number, website, Facebook, LinkedIn. I mean, if you can't reach us through one of these areas, you're just not trying, all right? So, all right. I always end this way, and that's because I believe strongly in, that we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. That's 2 Timothy 1:7. For we have not been given a spirit of fear. We're not fearful on this channel. We're not fearful because we're using the data that tells us what's really happening. Okay? And it is my deeply held belief that we will not only survive this pandemic, but we will emerge a stronger nation. And it really means a lot to me, guys, that you're here watching. Let me just check questions here. Liked your charts. Thank you, Mark, I guess. Okay. account. All right. Not sure what that is, but okay. So thanks for the presentation. Good contents. Thanks, guys. We appreciate it. I never take it for granted that you're here. Tell your friends, like our page. Let me know if those little short videos are useful. Tune in on Monday. We're here to serve. We're here to educate. We're here to keep you informed from COVID to clarity. This is CB3 Live.